Welcome back to More Fun with Finance. I'm Dr. William Elliott, coming to you from my studio in beautiful uptown Shaker Heights. So today's lecture is about the cost of capital. This is from chapter 14 in Ross, Westerfield, and Jordan. And so without any further ado, let me switch over to my slide deck here, get out of the way, and we'll get going. Okay. So just to give you a little heads up as to where we're headed, we're going to start off by talking about the cost of capital in general terms. Then we're going to break it up into each of the types of securities that we use to raise capital. That would be equity, stocks. That would be bonds or debt. And then kind of a hybrid security, preferred stock. We're going to look at all three of those. We're also going to deal with some issues that come up around whether the risk of the project being evaluated is similar to the risk of the average project in the company already, or do we possibly need to use a different cost of capital to evaluate it based upon its either being higher risk or lower risk than the average for the firm already. When I say already, I mean a project's already in place and operating. We'll also use a weighted average cost of capital in a way of kind of backing into a valuation. And then finally, one last issue that relates to flotation, that is, what's it cost to raise $10 million or $100 million using equity or debt? It's not free, and actually it can be a fairly substantial chunk of money. That means the project may or may not have a positive NPV after we take account of the issuance costs. All right, so on to the first topic, just kind of what is cost of capital. You can think of it as the required rate of return for the firm. Ultimately, it is the same thing at the end of the day. We use cost of capital as the discount factor when we're evaluating capital budgeting projects. So buying a new plant, buying property, buying equipment, things of that nature. We're going to look at the cost of those relative to the cash flows that they'll generate into the future. We're going to discount those cash flows that they generate out in the future back at the cost of capital and add those all up and then subtract off the initial cost. If the result is positive, then we have a positive NPV project and we do the project. If not, then it's negative and we don't do the project. One other little note here when it comes to capital structure, right? Remember, capital structure, we'll be talking about that actually in chapter 16, but the essence of capital structure is how much debt do we use to finance the asset base and how much of it is financed with equity or stock issuances. We're going to, for the moment, assume that capital structure is already determined, even though one would think these are jointly determined characteristics here where we, depending upon the capital structure we choose, that will affect our weighted average cost of capital, which will in turn affect whether a project is a positive or a negative NPV project. This gets a little stickier in those sorts of situations. There is no kind of unifying theory in finance that relates to that and deals with that issue. So for the moment, let's just assume that capital structure is relatively fixed, which actually, if you look at the average firm, that's not a terrible assumption. Most firms fall into that category where they have a relatively stable, where they have a relatively stable capital structure. All right, so let's start with equity. How do we get the equity cost of capital? That is just the portion of that capital that is from issuance of stock, and how do we determine what that cost us? Well, if you'll remember back into chapter 8 where we were looking at valuing a company, there was a model called the dividend discount model that we used, and this assumed constant perpetual growth. And if you'll take a look down here we have that same model. And let me get the marker going here. So here it is, this D1 divided by the cost of equity capital, that's the R sub E. minus the growth rate. So we're assuming that it's going to grow at some constant rate out into the future. So that's the model that we're using in Chapter 8 to value a company. Now, we're going to shift the terms around a little bit, and we're going to isolate R sub E over on the left-hand side, and down here is what we get when we make that change. So now we could plug in a dividend one period from now, divide that by the current price, and add to that fraction the expected growth rate in the future. And that should also presumably give us our cost of equity capital. So that's one method that could work to get that equity cost of capital. If we looked at an example of this, here we have this Greater States Public Service. It's a large public utility, and we know that the dividend paid last year was $4. Stock currently sells at $60, and it's expected to grow at a 6% rate on out into the indefinite future. So when we plug this in, first we're going to need to get D sub 1. The $4 is D sub 0. That's the dividend that was just paid. The D sub 1 would be that dividend grown at 6%, and that's what we do right down here. So we grow that dividend. That's going to be next year's dividend. That will be $4.24. We're going to plug that in here, and we're going to divide that by our $60 price. Actually, you can think of this as the dividend yield, and that is indeed what it is. That fraction D1 over P0 is, in fact, the dividend yield. We're going to add to it the amount of extra growth we expect, and that's going to yield a cost of equity capital of just a shade over 13% in this particular example. Now, the advantage of this method is that the price at time 0, that is today, we can see that in the marketplace. We can estimate what D1 is by knowing what D0 is and growing it at the expected growth rate. The thing that we're actually estimating with some error would be the growth rate itself. So we always want to put some sort of parameters around this. We would never ultimately use a cost of capital that was a single figure. I always like to use a range of figures, whether we're valuing a company or whether we're calculating its cost of capital. You're more likely to be correct with a range than you are with a single point estimate. All right, so how do we get the growth rate? There are several ways you could do it. The example they provide you here in the chapter is to actually look at the historical dividends and estimate a growth rate based upon that. So what they've done, let me flip to the next slide here. The growth rate between 2020 and 2021 was a 10-cent increase in the dividend on a $1.10 original dividend. So that's a 9.09% increase. Between 21 and 22, it went up by 15 cents, and on a $1.20, that's a 12.5% increase, and so on for the other two. So when we do that, and then we average it down here, we come up with a expected growth rate of about 9%. This has its problems in that it's not forward-looking. It's looking back at the past. Is the growth rate going to be the same going forward? That really depends upon whether it's the same company going forward, whether the economy is in the same state as the past 4 years, and so forth. But it gives us a starting point. I would, again, never want to use simply this method to get G. I would always want to look out forward and say, well, what else might happen? What else do I expect to happen? And how will that affect the growth rates? All right, so advantages, disadvantages, I've pretty much talked about that. But at least about the advantages, it's that you're only having to estimate one parameter with uncertainty. Disadvantage, clearly this one is the biggie. Many firms don't pay a dividend, so if we don't have a dividend, we can't use the dividend discount model, and that becomes a problem. We could use a cash flow based model. It's very similar to the dividend discount model, so that could alleviate that issue. The estimate of the cost of equity is very sensitive to the growth rate estimate. So that's a huge issue. And again, my point about using a range is the way of avoiding some of that problem. And it doesn't explicitly consider risk, right? Do you see any point in these equations where we actually explicitly consider risk? And the answer is no. This other method, using the security market line and CAPM, is something where we do explicitly consider risk. So if you'll remember back to, I believe it was chapter 10, where we started getting into CAPM, and chapter 11, we need to know a risk-free rate, we need to know a market risk premium, and we need to know the systematic risk of the asset relative to the average, that is the beta coefficient over here. Now, this model is literally the capital asset pricing model. When we take the expectations off and we estimate it using historical realized data, we get what's known as the market model. So the strict name for this is the market model, to differentiate it from the more theoretical, or not more, from the theoretical capital asset pricing model. So this is CAPM, and what differentiates it is these expectations. That's forward-looking. The implementation we're doing here with actual data is backward-looking. It's historical. So, as an example here, suppose that U.S. T-bills were paying, Suppose that U.S. T-bills were paying 4.72%. We'll use that as our proxy for the risk-free. We've estimated that the market risk premium is 6% in this case. And again, remember the difference between the market risk premium, or what we could also call the excess return, both are those are synonyms, is the expected return on the market as a whole minus the risk-free rate. So it's the additional return we get for taking on some risk, some business risk. And then finally, we need this beta estimate, which comes out of a regression. We're going to regress the returns of the firm itself on the returns of the market over a period of time. We have to pick the periodicity, or else, i.e. the frequency. We also have to pick the time frame, or the span. So this is a frequency versus span issue. We want as many observations as we can get, but 1 second by second doesn't make any sense. Minute by minute doesn't make sense. A lot of noise in those data figures. Even daily doesn't make a lot of sense. Most often, weekly, monthly, quarterly, or annually is used when one estimates a beta coefficient using regression. In this particular example, we're looking at Walt Disney with a beta of 1.29. We have our risk-free of 0.0472, and 1.29 times the market risk premium gives us just a shade under 12.5% cost of equity for the example of Walt Disney. Again, advantages and disadvantages. This model explicitly deals with risk, and it's applicable to all companies, not just those with steady dividend growth. The difficulty with it is that we're estimating a market risk premium. We're also estimating the beta coefficient. We're estimating those things with error. So again, put some ranges around it, and that should alleviate some of that problem. Also, as with the dividend discount model, we essentially have to rely upon the past to predict what the future is going to look like for a particular firm. So, cost of equity in an example. This is Alpha Air Freight, has a beta of 1.2, market risk premium is 7, and the risk-free rate is 6%. The last dividend for Alpha was $2 per share. The dividend is expected to grow at 8% indefinitely, and the stock currently sells for $30. So we've got enough data here to do both methods, both using the dividend discount model as well as the security market line, i.e. the market model method. So here, first, let's start with the market model. So we plug in here, we have 6% risk-free rate, we have a 1.2 beta, and we have a 7% market risk premium, giving us a computed cost of capital of 14.4%. Now, using the dividend discount model, we're going to plug into this formula right here. We have a dividend that was $2, but it's growing at 8%. So dividend 1, that is 1 period from now, 1 year from now, is expected to be $2.16. So there's our D sub 1. The current price, or P sub 0, is $30, and the expected growth rate is 8%. Add those together, and we end up with 15.2%. So thankfully, these are relatively close. They don't necessarily come out like this. So then it's going to require some sort of judgment to determine which one you want to take. Now, in this case, what the authors suggest is that possibly you just average together the two estimates and we go with a 14.8% cost of equity capital in this example. If you have more confidence in one method over the other, I would say no need to average, just go with that method. But even there, again, you're going to have some ranges. So you're going to have the cost of capital ranging between a low point here and a higher point over here. Now onto cost of debt. Cost of debt may, at least at first blush, appear to be a bit easier because, simply put, we're going to use the interest rate that the firm must pay on new borrowing. And we can observe this interest rate in the financial markets. Yes, that's true, but how do we know that we're using the right estimate? We're looking at another firm, possibly other issues of quote-unquote similar risk. How do we determine similar risk, and so on? So the devil is always in the details here. In this example, one other thing I want to point out is we never want to use the issued rate, the rate at which a bond was issued, maybe a year ago, maybe 5 years ago, maybe 10 years ago. We always want to use the current market price of that security and the market yield, the yield to maturity, the YTM. We always want to use that as opposed to historical data. The markets change, obviously, as we've all experienced recently. Interest rates go up, and as a result, your cost to borrow is going to go up. Now, here's an example. We have this General Tool Company issued a 30-year 7% bond 8 years ago. So 8 years ago, 7% was reasonable for this company. The bond is currently selling at 96% of its face. So let's see. So that's $960 with a $1,000 face value, which is typical for bonds. What's that mean about the yield? Well, if the price is lower, that means the yield is higher. So the current yield is going to be higher. We can actually calculate that. You can plug this into your financial calculator, figure out we'll assume semi-annual coupon payments. So that would be $35 per 6-month period. 16 periods left in this bond. We know that the current price is $960, so we could actually compute the yield by doing compute I. That's going to give us 7.37% is the current yield for this company. Now, one thing that doesn't take into account is, has that company reached the point at which additional debt is going to cause the firm to have a greater chance of financial distress and possible bankruptcy? That's a key factor, because regardless of what the current bond is selling for, that's the current bond, assuming no more debt. Well, there may be some expectation built in there already, but let's assume for the moment that this price doesn't factor in any new debt. If it did, that rate might be higher. Last thing to look at is this hybrid security, the preferred stock. Preferred stock has some equity characteristics. It has some characteristics that are more like debt. How do we price it? Well, we price it just like we price a perpetuity. Typically, it is viewed as a perpetuity because it doesn't usually have any sort of maturity date. And so we get some sort of payment labeled D, that's going to be our dividend, and we divide that by the current price to get our required rate of return on preferred stock. Now, obviously, if you'll remember, the formula for a perpetuity is actually the price of the perpetuity is the cash flow that we receive. In this case, we're going to call that D because it's a dividend, divided by the riskiness, the measure of riskiness, the required rate of return. So all we're doing here is multiplying both sides by R sub P, dividing both sides by P sub 0, and we end up with this version of that formula. So it's fairly easy to come up with a value for preferred stock. Here's an example. Suppose that we have Bank of America had two issues of ordinary preferred stock with a $25 face value. One issue is paid $1.50 annually per share and sold for $25.15. The other issue paid $1.47 per share and sold for $24.98. So we can look at the expected return or the required rate of return for each of these. In the first case, that comes out to be just a little bit under 6%. In the second case, it turns out to be 5.88%. If we were to average those two together, we could assume that we'd be using a 5.92% if we were to issue additional preferred stock. Now we have to put all of this data together. We put the equity cost of capital, the debt cost of capital, and the preferred stock cost of capital if we have preferred stock. We need to put that together somehow. How do we do that? Well, we weight them. Basically, we weight them based upon how much of the project is being funded by each of those three types of securities. In this example that they give here, we're just looking at actually equity and debt. So here we have equity and debt together equal the total value. And when we want to figure out what the percentage weight is on each, we just simply take the E over the total value plus D over the total value. That should equal 100% or 1. And that's each of those are going to be the weights that we apply. So when it comes to calculating the weighted average cost of capital, we simply use those rates times the after-tax cost of that particular security. And I emphasize after-tax mainly for the debt. Dividends aren't tax deductible, so the after-tax cost of equity is the same as the before-tax cost of equity. It doesn't change at all. But because interest payments are tax deductible, the after-tax cost of debt is different than the before-tax cost of debt. It decreases the before-tax cost of debt. And you can think of it this way. We're saving paying out some amount of taxes, and because we deduct that interest rate, so whatever that tax rate is on each dollar that we deduct, we're saving that amount. So that's going to lower our after-tax cost of borrowing. In that case, suppose that we have a firm that borrows $1 million at 9% interest, and that corporation has a tax rate of 21%. What is the after-tax cost of that? Well, the interest that we pay annually on that at 9% on $1 million is going to be $90,000. So that's going to decrease our taxable income by $90,000. The amount of tax that we don't have to pay because of that decrease is equivalent to $18,900. $90,000 off of our EBIT gives us EBT, earnings before taxes, and that earnings before taxes is going to be decreased by $90,000 because of that interest deductibility. and that's going to save us $18,900 worth of tax bill. An easier way to think about it is that whatever the cost of the capital is to start with, that would be, in this case, R sub D right here, times 1 minus T sub C, that's the corporate tax rate. That's going to give us the after-tax cost of our debt. Now, here's the full formula just for equity and debt. And many firms have preferred stock, but it's not a common thing to use that preferred stock to fund a project. So this is typically what you'll see is you'll see the weighted average cost of capital, and that is a function of the cost of equity times the percent of equity that we use on that project, plus the after-tax cost of debt, that's R sub D times 1 minus the tax rate, times the percent of debt that we use to fund this project. So that's, simply put, that's our weighted average cost of capital. We're going to be using this formula most of the time when it comes to calculating some sort of cost of capital for a particular project. If the firm does use preferred stock, then that formula gets updated slightly just by adding in this term right here, this P over V, that's the percent that is preferred stock for the overall project, times R sub P, that is the cost of capital for preferred stock. Here's an example of calculating a cost of capital. And suppose that we have BB Lean Co. They have 1.4 million shares of stock that is currently selling at $20 per share. The firm's debt is publicly traded, was recently quoted at 93% of face. The total face value is $5 million, and it's currently priced to yield 11%. The risk-free rate is 8%. The market risk premium is 7%. And we've estimated that BB Lean Co. has a beta of 0.74, and the corporate tax rate is 21%. So now we have all the data that we need in order to calculate a weighted average cost of capital. So first thing, let's use the security market line, or AKA the market model, to calculate the cost of equity capital. So here's our 8% risk-free rate plus the beta times the market risk premium gives us a cost of equity capital of 13.18%. The total value of the equity is 1.4 million times $20, so that's $28 million is the total market value of the equity. The pre-tax cost of debt is this 11%. We got the 11% from looking at our yield to maturity for bonds that are currently trading. And so the debt sells at 93% of face. That means that the outstanding market value of debt is $4.65 million. So add that together with the equity, and we have a total firm value in market value terms of $32.65 million. Now we can calculate the weightings for each of the equity and debt pieces. So for equity, 28 million of 32.65 million, or 85 and about 3/4% of the asset base, is paid for or supported by equity capital. The remainder, 1 minus that amount, or 14 and almost 1/4%, is supported by debt. So here we have 0.8576, that's that 85.76% of the capital is equity capital at the equity cost of capital, at 13.18%. And then the remainder is the 14.24 times the 11 on an after-tax basis. One correction here that I just noticed is that this should not be a times the multiplication, that should be an addition. So this is, in the formula, it is correct. It was just incorrect down here when they plugged in the numbers. We end up with a little over 12.5% for a weighted average cost of capital for BB Lane Co. Here we have a couple of examples. First one here is the warehouse problem. Suppose that you just became president of a large company and your first decision is to decide whether to renovate the company's warehouses. This project is going to cost $50 million and it's expected to save $12 million per year for the next 6 years. So what is the cost of capital and how do we use it? First off, let's figure out how much of our project is financed using equity, how much is financed using debt. We're going to assume that the target debt to equity rate remains where it was to begin with, which is at 1/3. So that would be debt over equity is equal to 0.333 ... Now, what's that really mean? Because remember, our weighting scheme is based upon total assets relative to each of the securities that's used to pay for them. So an easy way to do this is to realize that we've always got that 1 in the denominator, that latent 1 down there. And so we've $1 of equity is always matched with 33 cents of debt. So that means the total value of the asset base could be viewed as $1.33. So the equity over total value is $1 over $1.33 or 0.75. And then, of course, the debt is 1 minus the equity piece or 0.25, right? So here we have that shown down here. Cost of debt is 10% and the cost of equity is assumed to be 20%. We are told that the tax rate is 21%. So here is the formula for that weighted average cost of capital. And then that ends up being just a shade under 17% weighted average cost of capital for this project. Okay, so now we need to actually use that cost of capital in a problem. Here is the MPV problem right here. So we're expected to pay $50 million for the project. It's going to save us $12 million every year for the next 6 years. So we can view that 6 years of $12 million each year as an annuity. And that's what they do down here. So this is that formula to discount the payments of an annuity back to today and add them all up and tell us what that's worth. In this case, when we do that, we have 12 million times the 3.59 factor, which leaves us a little bit shy of the 50 million. So we end up with a negative NPV here. We would not take this project, all right, because of that negative NPV. Now, there's a little something we're going to talk about in just a few minutes that might temper that decision. And that is the question about, is this project as risky as the typical project in the company? Is this a project that has about the same amount of risk as the average project in the company? And if the answer is no, then we're probably using the wrong weighted average cost of capital to evaluate whether we should do this project or not. You know, something like a warehouse, improvement where we're going to save $12 million a year, we can calculate those figures with a fair amount of confidence. So probably what we're doing is automating some of the process. That's going to save us some labor. We can pretty accurately estimate those labor costs that are being saved, and then whatever additional maintenance we would have for the automated system gets factored in there, and the difference is that 12 million in cost savings. So that's a relatively firm number, relatively low risk project. So is it appropriate to use this 17% discount rate? That's the question we're going to be talking about here in just a few minutes. So if you were thinking along those lines, you are correct, but hold that thought for just one bit longer. Here's another example. Suppose that we've got a project that has an initial after-tax cash savings of $5 million at the end of the first year. These savings will grow at a rate of 5% per year. And the firm has a debt to equity ratio of 0.5. Cost of equity capital is 29.2. Cost of debt capital is 10%. The cost savings proposal is closely related to the firm's core business, so it's viewed as having the same level of risk. That's an important element here. Remember what I just mentioned on the prior example. Should the firm take on the project? Okay. So let's figure out, we've got a 21% tax rate, and here we can tell that if the firm should take the project if it costs less than $30 million. Why do we say that? Well, because of this right here. If we take we can view this as a perpetuity, a growing perpetuity actually. If you remember the formula for a growing perpetuity, the value of that perpetuity was equal to the cash flow generated by that perpetuity, discounted by the required rate of return for a perpetuity of that risk, minus the growth rate of that perpetuity. And that's effectively what we have done here. Instead of the required rate of return, we've used WACC, the weighted average cost of capital, or the weighted average required return. And then here's our growth rate. Our cost savings are the cash flow. So when we look at this and we calculate our percent of equity, that's 2/3 times the cost of equity at 29.2%. 1/3 is the debt times the after-tax cost of that debt. That's 10% times 0.79. We end up with a weighted average cost of capital of 22.1%. When we plug that in, tells us that the present value of that series of savings, that perpetuity effect, growing perpetuity, is equal to $29.2 million. So if the cost of the project is less than $29.2 million, that means we're going to end up with a positive NPV project, and we should do the project. If the cost of the project is greater than $29.2 million, of course the NPV will be negative, and we should choose not to do the project. Here's a brief summary of the things that we've just discussed already. I'm not going to spend any time going over that and belaboring that. I'll just leave this up here for a second. You can stop the video, read through it more carefully if you'd like to do that review. We can also use the weighted average cost of capital to evaluate performance of a company, kind of reverse engineering this. These techniques sometimes get referred to as the economic value added, or EVA, market value added, MVA, or shareholder value added, SVA. Here's an example of that. Suppose that we have $100 million in capital in a firm, and its overall weighted average cost of capital is 12%. So there's our 100 million, there's our 12%. If we multiply those two together, that means that that firm should be generating $12 million of cash flow based upon the asset base of 100 million. If it isn't generating 12 million, if it's generating less than 12 million, we're destroying value. If it's generating more than 12 million, we're adding value. And this whole idea is these things are very similar to NPV. It's just that we're looking at an existing firm trying to evaluate whether it's actually creating value for its shareholders or not. Now, this issue that I mentioned earlier about the riskiness of a particular project being equivalent to the average risk of projects in the company already, and whether we should use the company-wide weighted average cost of capital or some other cost of capital for a particular project if the riskiness of that project varies from that of the average project in the firm. And this example talks about it in terms of the SML, the security market line. Basically, if we look over here, let's look at this graph. So we're plotting the SML right here, ultimately. And this line right along here, the weighted average cost of capital of 15% for this particular firm. And this particular firm has a beta of 1. Now, Suppose it takes on a project like A up here, and that project actually is only going to yield 14%. But notice, and notice it's below the weighted average cost of capital line for the firm, but it's above the security market line. And notice that its risk level is considerably lower. It has a systematic risk of only 0.6, a beta of 0.6 rather than a beta of 1. As a result, this is a project that we should take on if we are able to do it, not because of the 15 versus 14, but because of the 14 being higher than what is required for a project with a beta of 0.6. However, if we use a strict weighted average cost of capital and we don't take into account variation in the riskiness of the project relative to the firm's average risk, we're going to overlook that particular project. Now, over here to the right, we have project B right here, and that project would actually be accepted using the weighted average cost of capital because it generates a 16% return, internal rate of return. And since we're evaluating it at 15%, we come up with a positive NPV. However, notice that it is below the security market line. It has a risk higher than the firm. So it's actually a project we shouldn't take. It's not returning enough for the level of risk that it has. Yet, if we just use a strict rule, one size fits all, that would be our decision. So as a result, if we keep using a strict rule like this, we're going to overlook some very good projects. We're going to take on some riskier projects that don't return what they should given their level of risk. So ultimately, at the end of the day, we're going to increase the overall riskiness of the company, and we're going to decrease the value of that company because project B would actually, if we correctly evaluated it, it has a negative NPV, whereas project A has a positive NPV. Now, obviously, ideally, we take any project that is above the SML, right? Anything that's up here, we would take regardless of the riskiness of it. We would take those projects. We would avoid taking any projects that are below the SML. So we really do at some point need to evaluate the riskiness of the project vis-a-vis the average risk of projects already in the firm. So I've already really talked you through this slide. This slide just talks about the appropriate required rate of return for project A. Turns out that project should be evaluated at 11.8%. And if we did, we would take that project. Similarly, project B, if we evaluated it at its correct cost of capital, we would reject that project. So how do we deal with this? This example here that they offer is a company that has two very different divisions. One is a relatively low-risk division. It's electricity generation. And the other is electronics manufacturing, a relatively high risk. So one way of dealing with this is to have a different cost of capital for the low risk, obviously a lower cost of capital for their projects, and a higher cost of capital for the high-risk division. That's one way of dealing with this. It oftentimes doesn't work in practice because the firm ends up with a kind of an internal battle over which projects fit into which division and so forth. There are numerous examples. One I'm familiar with is a company in Tulsa that used to be in the pipeline business, actually still is, Williams Company. And they had a division that through some serendipity actually became a very high-tech fiber optics firm. And so they were together in a single firm. Trouble was that there was so much friction between the management teams in each division, they ultimately had to split the firm up. And that didn't work out so well either because of the way they did it, but that's getting too deep into the details of that project. But you get the point. is that many times it's difficult to work this out as clearly as an example that we made up here in the textbook. Another way to go about it is to kind of look at what is the riskiness of this project if it were in a pure play meaning just that project or a company that just does that type of projects. Could we find a company like that and estimate its weighted average cost of capital and use that as a measure for each of our projects? Now, we'd have to obviously do that on each project, and we would have a very, our weighted average cost of capital could be very much higher for some projects, very much lower for other projects, and so forth. That's another possible way. Yet a third method, and this is probably the one that many firms would go with, is to try to break things up into different buckets. All right, so we've got a high risk bucket, we have a moderate risk bucket, we have a low risk bucket, and then we have a bucket of things that we absolutely have to do simply because they're regulatory issues, and we have to do those projects. So we can pretty much ignore this last category. And the high risk bucket, we're going to add 6% as an extra factor or as an extra cost on our weighted average cost of capital. In the moderate risk projects, we're going to add nothing, just going to take the calculated weighted average cost of capital. And on the low risk projects, we're actually going to subtract 4% from the moderate weighted average cost of capital. So here you see that same graph, and we have a couple of projects here. Now, in this case, we're looking at project A right here. Notice that it is, not only is it below the SML, but it's also below the cost of capital for this high risk project. That is the weighted average cost of capital plus 6. So we would actually reject this project. Now, if instead of being where it is, it was, say, over here, what would we do with that? Same systematic risk. It's above the SML. Yeah, but it's below our weighted average cost of capital for high-risk projects. So we would still reject that project, even though this project is actually should generate a positive NPV if we use the appropriate cost of capital, which would be this. Whereas this first project A we'd reject in both cases. This second project that I put up here, we would actually reject it, but we should have taken it. So while having these different buckets minimizes the problem, it doesn't completely alleviate or remove that problem. Another thing we can do with weighted average cost of capital is we can use it in a valuation model. All right, so here we're actually valuing the entire company as opposed to simply valuing the equity portion of the company. We start on the income statement, not down at the bottom, because that's equity only. We need to move back up that statement a little bit, up to EBIT. So we're going to be up there at the, oops, that marker didn't work. Hang on. We're going to be up here at EBIT on the income statement. So before interest and taxes. Now, we do want to calculate what is our interest burden on that EBIT. So simply EBIT times the tax rate. And you might be saying, well, wait a minute, how come you're not accounting for the interest deductibility? And the answer is that we're actually decreasing the cost of debt to an after-tax basis, so we don't have to deal with that. That's already factored in that particular part of the equation. And then if we do that, we end up with EBIT minus the taxes. Now, we need to add back some things, and in particular, that's depreciation, and if we have any amortization, that also gets added back because that's a non-cash deduction, so it's not a real, we're looking for real cash flows here. So we add that back in. Now, we also have to subtract out things that eat up cash. So if we're changing our net working capital, if we have more need, if we have higher volume, probably means that we have a higher net working capital, so we subtract off the increase in NWC. Now, obviously, if NWC decreased, that would be adding. We'd add that back in. Likewise, for long-term capital expenditures, CapEx as it's known, we want to subtract those off too. And again, the reverse holds true. If we sell an asset and it generates cash flow, that's actually a positive. That would be a reduction in CapEx. Now, we can rewrite this and simplify it a little bit by combining EBIT and the taxes into a single term. And then we still have our depreciation, change in NWC, and the CapEx down here. So that gives us what is also commonly known as free cash flow to the firm, FCFF. If you see that, that's exactly what that means, free cash flow to the firm. There's another one that we're not going to deal with here, but I just want you to be aware of it, and that would be FCFE. And that is free cash flow to equity. So there we take account of having to pay the interest out to the debt holders and things of that nature. And we end up with just the free cash flow available to equity. That's another valuation technique. Slight variation on this, but we're not going to look at it in this particular class. Here we're really about trying to give you as much breadth as possible about corporate finance. All right, so we have this free cash flow to the firm, and that's this this figure up here that the authors call CFA, but like I said, it's also FCFF. We're going to assume that is a growing perpetuity, all right, and that's what this denominator actually suggests. And we know that our weighted average cost of capital is 9%. We have an expected growth rate of 5%. And we have 120 million in free cash flow to the firm. So that means that the value of the firm, that is both equity and debt, is $3 billion. All right. We could do this on a non-constant growth situation as well. That's illustrated down here. Suppose that it's growing at a non-constant rate for t periods, and then from time t out to infinity, it grows at a constant rate. And this is the way of dealing with that. Notice in particular over here, this last term, we have that last non-constant rate cash flow, CFA sub t. In case you can't see that, that's CFA sub t. Plus this V sub t. So plus V sub t. Well, what is V sub t? Well, it's right down here. And again, this is another constant growing perpetuity. Or sorry, I shouldn't say constant. It is a growing perpetuity. All right. Let's put this on a timeline just to illustrate. Out here, we're going out to infinity. This is time t. This is time 0, 1, 2, 3, 4, 5, 6. So time t is 6 in this case. So we've got these cash flows for time 1, time 2, 5, all the way up to time 6. So we've got CFA 6. Now, we're put yourself at time t, looking out into the future. So we're looking out from here out into the future. What do we get in the future? Well, we get CFA 7, 8, 9, 10, all the way out to infinity. And that's why we're using this growing perpetuity model again, but standing out at time t. So you can think of this as we hold the firm for 6 periods and then we sell it, and the person who buys it from us is buying it at a price that's equivalent to the discounted future cash flows from time t on out. So in my example here, it'd be time 7 on out. Now, one other thing we have to note, since V sub t is calculated as of this time, and we're trying to value things as of today, time 0, we need to discount it back those 6 periods, right? And so that's why it's over here and here's the discounting. It actually occurs a second after we get that cash flow for year 6. And then we're assuming we grab that cash flow, we sell the firm for V sub T or V sub 6. And so both those cash flows occur effectively at the same time. And so we discount them back together. Flotation costs are another very important factor that we have to consider. They are non-trivial costs related to issuing stock or issuing debt. And there's often a fixed component as well as a variable component, depending upon how much we raise. And actually, to give you some sense of the magnitude of these costs, there's a very famous paper in the finance literature called the 7% solution. Obviously, a little nod to the Sherlock Holmes 7% solution. But here, in this case, they're talking about 7% is the typical commission that is paid to an investment bank to do a initial public offering. Smaller firms, some smaller firms will pay more. Larger firms might pay a little bit less, but on average, it ends up being around 7%. So that's a pretty sizable chunk of change. It's good to be an investment banker, I guess. All right, so here's an example. We have the SPAC company. Let's assume for the moment that it's an all-equity company. It has a cost of equity capital of 20%. And so since it's 100% equity, its WACC is also 20%. SPAT is contemplating a $100 million expansion. They believe that the flotation costs are going to be 10% of the amount raised. So that means they only have 90% of what every dollar that gets raised. They only get 90 cents of it. 10 cents goes to their investment banker. So how much money do we need to raise in total for SPAT to end up with $100 million? And the answer is obviously $100 million divided by 0.9 or $111.11 million. So that extra $11.11 million is part of our cost, right? So when we subtract off the initial cost, we're going to subtract off that extra $111.11 million in this particular example. Now, let's take that same company, and instead of it being all equity, let's assume that it has a capital structure, 60% equity, 40% debt. And one additional thing, they don't really mention it in great detail here, but let's assume that the new project is being funded also with 60% equity, 40% debt. That's somewhat unusual, and that is because there's a fixed cost component to both the equity issue and the debt issue. They're separate, and as a result, we're going to be paying probably a little bit more overall than if we just went with all equity or all debt, and we let our target capital structure drift a little bit away. Many times, because companies typically generate some positive retained earnings at the end of each year, many companies will mainly be issuing debt because the equity grows organically as a result of retained earnings. But let's get back to the topic here. How do we actually get this average cost of flotation? Well, we do the same thing that we did with weighted average cost of capital. We take what percent is equity, we take the percent that is debt, and the equity times its cost, and the debt percent times its cost. In this case, we're told that 10% is the cost of the flotation for the equity. It's only 5% for debt. Overall, we have an 8% cost. So what do we need to raise in order to yield our 100 million? And that is 108.7 million, or 100 million divided by 0.92. We have the Triple Day Printing Company. It's considering a new building for its printing operations that's going to cost $500,000. The new plant is expected to generate after-tax cash flows of $73.15 thousand forever. Tax rate is 21%. There are two financing options. One is to issue new common stock, and the issuance cost is 10% of the amount raised, and the required rate of return on new equity is 20%. The other alternative is to issue 30-year bonds. The issuance cost of those is only 2% of proceeds, and the company can raise new debt at a cost of 10%. What's the NPV for the new printing plant? Well, if we use a weighted average cost of capital here, we have that half of the firm is financed with equity at 20%, half is financed with debt at 10% before tax. On an after-tax basis, it's 0.79. Add those two together, and we get just a shade under 14%. We discount our perpetuity of $73,150 by that the 13.95%, and we end up with a present value of $524,373. All right, so, and subtract that from that, the cost leaves us with a positive NPV of $24,373. But we haven't taken account of the flotation costs, so we need to do that. And again, it's a weighted average, 50% at 10% for the equity, 50% at 2% for the debt. So a total flotation cost of 6%. And on a $500,000 investment, that becomes $531,915. So when we subtract that, we replace the 500 with 531.915 thousand. We end up with a negative 7,500. So in this case, the project doesn't go. One last thing to look at is that, as I mentioned earlier, many companies generate a positive retained earnings figure from prior years and will oftentimes use that extra money, that internally generated cash flow, to fund new projects. They might need to supplement that with some debt. And in fact, adding the debt will actually bring their target debt ratio back up. If we didn't issue debt, our debt ratio would continue to decline as we added to our equity side of the balance sheet with retained earnings. So this actually is typical of many firms where the equity cost of flotation is actually zero. Notice that down here we have zero for the flotation cost of equity because we're using internally generated equity. And then we still have our 2% here for the debt, so that ends up being only a 1% flotation cost in the case of when we have internally generated equity to partially pay for the project. And that is it for Chapter 14. We've talked about cost of capital. We've talked about weighted average cost of capital. We've talked about how to use that weighted average cost of capital to evaluate a firm, to value a firm in general, as well as the flotation costs related to raising debt and equity capital. And next lecture will be the last for this particular class. That'll be Chapter 16. We're actually going to be talking about the capital structure of the firm. You're going to find that there are a variety of theories out there. The one that we've been looking at here is this idea that there's some sort of target capital structure, but that's just one of a multitude of theories that relate to firm value vis-a-vis capital structure of that firm. So look forward to that one, and I will see you all in Chapter 16. Good evening.